In this video, traders, we are going to look at what is mean reversion trading. Stay tuned. Hey guys, warm welcome to you. All right, so in this quick video, I want to give you an overview, should I say, of what mean reversion trading is, so you kind of go, yeah, I get it, I understand it, great, move on. So we've got really two categories of trading. We've got more than that, but let's keep it simple for now. Trend trading or mean reversion trading. And they're kind of, sometimes they're called different things, but really the definition is this. For a trend trader, you are looking for a continuation of the move. So if the move is going higher, you're looking for it to go further higher. So you could call it an inside out trade, out being the outer ranges and extremes. And you're looking for price to come from in, to go out, to push further, to go to extremes, to carry on, to keep moving, to keep going in the same direction, to have that momentum. That's a trend trader. Now, mean reversion, which is why you're here, is someone who is trading outside in, looking for those extremes of move for it to come back inside. Now, the reason it's called mean reversion is that we are using some type of mean, i.e. average. And that's subjective. Some people use a moving average, you're familiar with that. Some people use a VWAP, a volume weighted average price, got loads of videos on that. Some people use a key level, a support level, a pivot point, an open, a close, something like that. So you come up with the mean, but the idea is, the theory is that price is always going to revert to its mean. And by the way, that mean doesn't necessarily mean it's flat. It doesn't have to be flat. So it's not necessarily like a range bound type trade. That mean could be sloping up. It could be a sloping up moving average. But still, mean reversion trader says, hey, I'm expecting that to come back to its mean, whichever direction I'm trading. A trend trader is saying, hey, I'm expecting it to go further on. So let's look at that example. Okay, so you've got this scenario now where, okay, if we imagine this is a trend, right? This kind of section here is a trend. It's doing this, it's doing this, it's doing this, right? A trend trader buys it in expectation for it to go higher. So they are looking to take advantage of this. A mean reversion trader is basically saying, okay, I'm putting that as the mean. Let's say it's a moving average, let's say it's a midpoint of a channel, whatever it is. They would trade from here to here and from here to here. They'd say, hey, the mean is sloping up, fine, there is still a trend, and this is the confusion sometimes. Not necessarily we don't trade in a trend, but a mean reversion trader says, hey, it's overextended from the mean, I think it's going to come back to the mean. And they're looking for those kind of moves back and forth, overextension, overextension. Now, a good mean reversion trader, in my opinion, would probably only position on the long side here and look for extension from the mean to the downside and use the trend to his advantage. So rather than kind of trying to short the tops here, he might go, yeah, I'm going to trade the bottom back to the mean, come out here, and maybe he looks for a little bit further extension and kind of is a bit of a hybrid trader, but that's by the by. A trend trader is kind of maybe buying on a pullback, but expecting it to carry on and carry on is a slightly different approach. You know, if you look at this type of scenario, a trend trader would be buying here, expecting it to go here. A mean reversion trader is saying, okay, what is the mean? How do I judge when we're extended away from the mean? And some of those tools are like a Bollinger Band, a Keltner channel, pivot point, perhaps, you know, there's floor trader pivots, you've got P1, S1, R1, that ton of stuff. There's many out there, kind of tools that allow you to kind of get an idea of this. But the theory is there's your mean, we're moving away from it, and imagine you've got this rate, and this is a very classical kind of textbook scenario, I get it. But you might say, okay, here's the mean here, it's the midpoint of this, we're in this kind of range bound scenario. A mean reversion trader, it has that as a mean, and at the end, that's the subjective part of it. Right? You have to decide what the mean is for you. Is it a dynamic mean like a moving average, or is it a static mean like a kind of support resistance level or close or open? And then you might say, hey, it's been in this range now, as we come up here, we are extended from the mean, and imagine you've got a spring, you know, the mean reversion trader waits for that spring to be stretched, tries to time that, and then trades for the spring to come back and compress. Whereas the trend trader looks for the spring to compress and to expand and expand and expand, and hopes that they can kind of get that further expansion, and probably prepared to sit through a lot of mean reversion type trades or mean reversion moves during a bigger trend, because they're not always just one or the other. Sometimes you have a bit of both. You know, even in this example, you could say, hey, there's a trend there, and there is. But overall, in this bigger picture, it's a mean reversion trade. The spring is stretched, people are trying to get short and they're trying to time that with some sort of trigger, some sort of engulfing candle, some kind of candlestick pattern like that. Maybe it's exhaustion candle with a big wick on it, something like that. It's stretch. They see that, they take the short, comes back. Most of the time, mean reversion trader is going to be coming out when the spring goes back into its kind of compressed state. They're not going to try and look for it to be extended again in the other direction, or if they are, they're probably out of the trade, then coming back in and going long here for it to come back here. And so, as a mean reversion trader, which is a very, very popular way of trading, by the way, guys, and a lot of hedge funds kind of do this in a pair structure. They take one company and the other, and they kind of trade a ratio of the two, and expecting that if it's the same sector, the same kind of industry, they're going to move in sync, generally speaking, in terms of profitability, and market cap might be slightly different, but they're going to be affected by the same things. If one starts to overvalue the other and starts to creep ahead, they might short that one and buy that one, expecting for that kind of differential to come back to the mean, and they close a position. And that's a kind of extreme, a very specific example, but really the kind of simple way of looking at it is to say, okay, it's a mean. I'm defining a mean as a trader. Okay, VWAP popular one, moving average popular one, those levels that I talked about before are popular one. Judging when it's extended from that mean in the right conditions. So if you're looking at a VWAP or a moving average, like a flat one of those is quite nice. You don't necessarily get it with a moving average, to be fair, but a flat VWAP is quite good when it's extended, it's already come back and it's been oscillating around. As it's extended, it's finding that sweet spot to fade that move and come back. And actually, final thing, I don't want to kind of pretend that these exist on their own. In a trending environment, you can still trade mean reversion, or you can kind of stick and trade with a trend, but you can also fade the trend. A mean reversion trader might well look to short this exhaustion move. Now, this is tricky and something that's quite advanced to do, and there's various things to look for that exhaustion move, but that will be considered a mean reversion trade as well. Looking for the end of the trend, the final flurry, the final squeeze, an aggressive move, unsustainable volume, unsustainable range, bang. Mean reversion trader looks for a 1 or 2 day pullback. That's it. They don't look for a complete reversal of the trend. They look for it to come back to the mean, which, if that's the mean and they're kind of saying, there's my mean, and we've kind of done this, well, we're going to be spiking, they're thinking, hey, we're going to head back towards the mean. We might not come right back to it, but the meat of the trade might be finding that sweet spot and for it just to contract a little bit, because the market can stretch away from a mean for a long period of time. But like I say, the mean can be dynamic, so that doesn't necessarily mean that you always got to have a flat line and go, well, it's way up there, it's got to come back down there. It's just assessing the conditions, judging the rhythm and structure of the market, and saying, right, should I be trading with the trend here, looking for inside out type trades, or should I be trading against the trend and looking for outside in trades, or should I be trading with the trend still and looking for the mean reversion, or should I be waiting for a range bound environment when it's a little bit quieter, a little bit calmer, and we're kind of bouncing off highs and lows, we've got an obvious center point that I can use as a mean. That's mean reversion trading. Hope that's helped. See you in the next one. Take care. Keep your risk managed. Bye bye.